Hello, welcome to our conversation on understanding the financial statements. In this session, we will examine the return on equity using the DuPont framework. So, the return on equity is one type of a measure of profitability, and the DuPont analysis is a model developed by DuPont Corporation in late 20s for a detailed assessment of the company's profitability. The DuPont analysis as a tool, it helps us in understanding the drivers of profitability. In order to take decisions relating to profitability, it is always useful to understand what are the drivers of profitability. And when we say profitability, we talk about return on investment. And the return on investment, there are variations in which you can find return on investment. It can be return on equity or return on capital employed. The focus of this session is on return on equity. Return on capital employed is profit before interest and tax divided by the capital employed, whereas return on equity is a PAT by equity. Equity is money contributed and money generated by the business for the shareholder. So equity is capital plus reserves, or equity is the total assets minus liability. Whereas the capital employed is both equity, money contributed by the shareholders, and also the debt holder. The focus of this session is on return on equity. We want to understand, examine the drivers of ROE, to manage ROE, to improve ROE, to understand why and how the ROE is behaving. And that is where we fall back on the DuPont analysis. The DuPont analysis says, understand and accept this fact that the PAT by equity is a function of operating decisions, financing decisions, and investment decision. That means PAT by equity can be managed by managing all the three decisions, that is operations, investment, and financing. So using that framework, it says PAT by equity is a function of, is a product of PAT by sales, which is a reflection of the profit profitability. Sales by TA, which is a reflection of the how efficiently the company is using the assets, and total assets by equity, which is a reflection of leverage or the way the financing decision. So PAT by equity or ROE is a product of PAT by sales, sales by TA, and TA by equity. So let us see the financial state data of Asian Paints and check this first level classification of the DuPont ratios. So return on equity of Asian Paints is 23%. So this we calculated from the balance sheet and income statement. The balance sheet shows the equity and the income statement shows the PAT. So return on equity is 23% in the year for the year ending 31st March 2022. And the DuPont framework says it is necessary to classify and derive the drivers of ROE, and that's what will do here. So the PAT by equity can be further drilled down into the profitability, efficiency, and the leverage. Profitability, efficiency, and leverage. So let us observe that. So PAT by sales is 12%. Sales by TA is 1.29. That means sales is 1.29 times of the total assets, and total assets is 1.49 times of the equity. Now, we will pick up each box individually and then examine them by using the profitability, that is ROE. Just to test PAT in by sales into sales by TA into total asset by equity is 23%, right? Is 23%. But in order to make use of the DuPont analysis, now there is a need to understand how to improve this, how to analyze this PAT by sales, how to analyze the sales by TA, and how to analyze the total assets by equity. So the framework goes on like this. Now let us examine the PAT by sales. So PAT by sales, both the items are from the income statement. So there is a need to examine the composition of income statement, and the composition is to explain the top line, which is sales, the bottom line, which is profit, and above the line, which are the expenses. So the DuPont analysis says that PAT by sales is maybe low because of the tax burden, or may be low because of the interest burden, or may be low because of the expenses or operating expenses burden. So that means you need to understand, why is PAT by sales low? Is it because of tax? Then do some tax planning. Is it because of interest? Then do some financial planning, capital structure planning. And if it is because of expenses, then understand those expenses and examine those expenses is the contribution of the DuPont. Let us see the tax burden, interest burden, and OPEX burden of Asian Paints. Let us see these three burdens of Asian Paints. So we are observing that PAT by sales can be further subdivided into PAT by PBT. If you can observe the income statement, we can also see that very clearly. So PBT to PAT ratio. So that means PAT is 75% of PBT. So that means the tax burden is 25%. There are cases it's possible to reduce the tax burden 25%. And if the tax burden is reduced from 25 to 22, then PAT by PBT will go up. All other things remaining constant, the PAT by sales will go up. And when all other things remaining constant, if PAT by sales goes up, then ROE will go up. So managing ROE by managing the tax burden. If you say, no, my tax burden is in line with the industry, then examine whether there is an interest burden. Observe what is interest burden. Interest burden PBIT minus interest is equal to PBT. So therefore, I can improve this ratio by reducing the interest. And if you see that interest is high, go back to the balance sheet, examine the composition of capital employed. If the debts are high, reduce debt or reduce the interest rates and interest. If the interest burden is also in line with the industry, tax burden is also in line with industry, then maybe the problem is somewhere on the expenses, COGS, employee cost, other expenses, depreciation. So in this example, PBIT by sales is 17%. So 83% of the sales in the form of expenses. So that is why the DuPont framework says, now it's time to examine this OPEX burden. And OPEX burden can be examined by drilling down the OPEX by sales. OPEX consists of COGS, operating expenses other than depreciation, and depreciation. So to improve PBIT by sales, we need to reduce expenses. The question should be, which expense? COGS or salary or rent or commission or depreciation. So let us see what is happening in case of Asian Paints. Asian Paints, 83% of the sales are the expenses. So what are those expenses? COGS is accounting for 61% because paint industry is more is a production, isn't it? So COGS is accounting for 61% of the sales. The employee cost is accounting for 5% of the sales. Depreciation is accounting for 3% of the sales. If some of these expenses, if possible, can be managed, improvement with efficiency, improvement with better machines, then if the expenses reduce, all other things remaining constant, PBIT by sales will go up. And if PBIT by sales goes up, PAT by sales goes up and ROE can be improved. So in the process, you are able to see that the DuPont analysis very nicely shows the drivers of ROE. At the same time, it shows the interrelationship between the financial statements, balance sheet, income statement. Okay, so the DuPont framework is a comprehensive analysis of financial statements. So now let us go to the next block. So we have examined the PAT by sales as detailedly as possible. Now let us examine this box which shows efficiency, how efficiently you are using the assets. If the efficiency is high, that means you are using your assets efficiently, then the sales by TA should be lower than the industry average. If sales by TA is not comparable to the industry, is very high or very low, then it is necessary to examine why the sales by TA is very low. Is the sales by TA low because the TA is high, and TA is high because of current assets or non-current assets? So the DuPont analysis says, don't stop here. Drill down the total assets into NCA and CA. And if you want, you can drill down further that is the CA high because of cash? Are you keeping idle cash on the balance sheet? Or the debtors are high? Or the inventories are high? So answering these questions will help us in managing assets efficiently. If assets are managed efficiently, the sales by TA will go up. If sales by TA goes up, all other things remaining constant, PAT by equity, they will go up. Okay. So let us see the sales to assets. Okay. So um, of this company. Okay. So sales by total assets is 1.29. Sales by non-current asset is 3.5, and sales by current asset. But remember, unlike the profitability analysis, these numbers standalone are no meaning. You need to examine the industry performance, competitors' performance, and understand an intercompany and intra-company analysis and make sense out of it. So that is managing assets efficiently. The last part of the DuPont analysis is examining the TA by equity. Is PAT by equity low because equity is high? If equity is high, is it the composition of equity is big amount of reserves sitting on your balance sheet? If big amount of reserves sitting on your balance sheet, then maybe it's worth examining, can I reduce reserves by distributing profit in the form of dividends, particularly cash dividend? Or should I go for buyback? So now to summarize all this, the DuPont analysis very nicely captures the effect of all these ratios on PAT by equity. And PAT by equity is a variation of one of the ways in which the return on investment or profitability is examined. The DuPont analysis says it is possible to understand the drivers of ROE. It's necessary that you should understand the drivers. then examine the possibilities of taking actions to improve the return on equity. So, DuPont analysis is therefore a very comprehensive analysis of the financial statements available to examine the impact on the profitability. Here we have taken return on equity, but you can do the same work, you can use the same framework for return on capital employed or return on total assets or return earning per share. Any variations can be used to can be taken as a basis for calculating and deriving the DuPont ratio. And this chart is called DuPont chart. But a question may come to your mind that will this be meaningful for a loss-making company? Yeah? Because we took the example of Asian Paint, which is a profit-making company, and the profit-making company's ROEs was positive, and then it gave all these breakups. To give you some picture of a loss-making, I'll just show the first level is a PayTM. This is the PayTM, which is a loss-making company. So PayTM's return on equity, unlike the Asian Paint, is negative 26%, whereas the ROE of Asian Paint is positive 23%. So why is PayTM's ROE 26% negative? And DuPont analysis helps us to throw some light on that 53% of the PAT by sales is negative 53%. So if PayTM has to improve its ROE, or they have to focus their attention on examining or converting PAT by sales from negative, reduce negative and increase. But to do that, there is a need to understand every expense. The expenses of a company like PayTM are not same as for the company like Asian Paints or company like FMCG, like let us say HUL. So the expenses of PayTM are payment processing charges, marketing and promotional expenses, the software, cloud data and data center expenses, and of course the depreciation. But so significant amount of expenses will be different from a very conventional income statement expenses, because the business itself is different. So if you observe, for a loss-making company also, you can undertake a DuPont analysis, and also a profit-making company like Asian Paints. So DuPont framework helps in examining the drivers of return on it. The bottom line is, in order to understand return on investment, whether ROCE or ROE, you need to use the interrelationship. You need to understand the interrelationship between the profitability, efficiency, and leverage, and then keep on drilling down to understand the overall performance of the company. Thank you.